Japan, once the top holder of U.S. debt, is now selling billions in Treasury bonds. But why? And how will this affect the U.S. dollar? Let's dive into the reasons behind this major economic move. This isn't just a small change in investments. Japan's actions could have big impacts on the global economy. We're talking about the potential weakening of the U.S. dollar and changes to international trade. These are things that affect all of us, even if we don't realize it. By the end of this video, you'll understand why Japan is selling U.S. treasuries and what it means for the future of the U.S. economy. We'll look at the risks Japan faces with these investments and why they're choosing to sell now. This is important stuff that could change the way countries do business with each other. So, let's get into it and see what's really going on with Japan and U.S. treasuries. To grasp the full picture, we need to rewind the clock. Japan's journey from post-war recovery to becoming a major player in U.S. treasury markets is a story of economic transformation. How did a war-torn nation become one of America's biggest lenders? The story of Japan's investment in U.S. treasuries is a fascinating one that dates back to the aftermath of World War II. In the years following the war, Japan's holdings of U.S. debt were minimal, reflecting the country's focus on rebuilding its shattered economy. But as Japan's economic miracle took hold in the 1960s and 1970s, things began to change. Japan's rapid economic growth during this period led to significant trade surpluses with the United States. As Japanese exports flooded American markets, the country found itself with an increasing amount of U.S. dollars. Rather than simply holding on to this cash, Japan began investing heavily in U.S. Treasury securities. By the 1980s, Japan had become one of the largest foreign holders of U.S. debt. This shift wasn't just about finding a place to park excess dollars, it reflected a strategic approach to managing foreign reserves and stabilizing Japan's currency. U.S. Treasuries were seen as a safe and reliable investment, offering stability in an often turbulent global economy. The perception of U.S. Treasuries as a safe haven was reinforced during times of global financial uncertainty. After the 2008 financial crisis, Japan's holdings of U.S. debt increased substantially. This move was part of Japan's economic policies aimed at maintaining large reserves for currency stability and economic security. As of September 2024, Japan remains the top international investor in U.S. government bonds. However, it's important to note that Japan's holdings have fluctuated significantly over the years. These fluctuations reflect changing economic conditions, policy decisions, and global financial trends. The evolution of Japan's treasury investments showcases a remarkable shift from a recovery phase post-World War II to a strategic approach in managing its economy on the global stage. It's a testament to Japan's economic resilience and its ability to adapt to changing global financial landscapes. But why has Japan maintained such large holdings of U.S. treasuries for so long? Part of the answer lies in the perceived stability and liquidity of these investments. U.S. Treasury securities are considered one of the safest investments in the world, backed by the full faith and credit of the U.S. government. For Japan, a country that has faced its own economic challenges in recent decades, including deflation and slow growth, the steady returns from U.S. Treasuries have provided a welcome source of income. Moreover, these investments have helped Japan manage its foreign exchange reserves and maintain a stable currency. However, as we've seen in recent months, even long-standing investment strategies can change. Japan's recent sales of U.S. treasuries raise questions about the future of this investment relationship. Are we witnessing a temporary adjustment or the beginning of a more significant shift in Japan's investment strategy? Japan's recent moves have sent ripples through the financial world, but what if these actions are just the tip of the iceberg? The truth is, investing in U.S. treasuries carries hidden risks that could shake the foundations of global finance. When we think of U.S. Treasury securities, we often picture a safe, reliable investment. But for foreign governments, the reality is far more complex. These investments come with significant risks that can impact entire economies. One of the biggest dangers is the impact of rising U.S. interest rates. When rates go up, the market value of existing treasuries goes down. This can lead to substantial losses, especially during sudden rate hikes. These hikes often happen when inflation starts to climb, catching investors off guard. Another major risk is the weakening of the U.S. dollar. When the dollar loses value, so do the investments held in that currency. This is particularly problematic for countries with volatile or strengthening currencies. They might find their U.S. Treasury investments worth less when converted back to their home currency. Inflation is another threat that can eat away at the value of these investments. If the inflation rate climbs higher than the yield on the treasuries, the real returns can actually turn negative. This means the purchasing power of these foreign reserves is being eroded over time. Political and geopolitical tensions also play a role in increasing investment risk. U.S. debt ceiling debates, for example, can disrupt market confidence and access to financial markets. These political squabbles can have real-world consequences for investors around the globe. During financial crises, liquidity risks become a major concern. Large holders of U.S. Treasuries might be forced to sell at lower prices, negatively impacting market values. This can create a snowball effect, with falling prices leading to more selling, further driving down values. Countries with substantial holdings like Japan face what's known as concentration risk. This means they could face significant losses if the U.S. financial system struggles, or if the dollar sharply declines. It's like putting all your eggs in one basket. If that basket falls, the consequences can be severe. Japan's recent actions highlight these risks. As the top international investor in U.S. government bonds, Japan's decisions carry weight. Their sell-off could lead to higher Treasury yields, as bond prices tend to drop when substantial holdings are liquidated. This isn't just a problem for Japan, it could impact the entire global financial system. The potential consequences of Japan's actions are far-reaching. If Japan decides to divest substantial portions of its US and EU Treasury holdings, it could profoundly impact the financial landscapes of both regions. This isn't just about numbers on a balance sheet, it's about the stability of entire economies. These risks help explain why Japan has been reducing its Treasury holdings. In March 2024, Japan held U.S. Treasuries worth about $1.87 trillion. By May, this figure had dropped to around $1.128 trillion. That's a decrease of nearly $750 billion in just 2 months, a staggering amount by any measure. While $750 billion sounds enormous, it's not the whole story. Japan's recent Treasury sales have been precisely calculated. What's the true scale of their divestment, and why does it matter for the global economy? Let's break down the numbers to get a clearer picture. In March 2024, Japan held U.S. Treasuries worth about $1.87 trillion. By May, this figure had dropped to around $1.128 trillion. That's a staggering decrease of nearly $750 billion in just 2 months. But here's where it gets interesting. Japan sold a total of $59.5 billion in U.S. Treasuries, including $22 billion in May and $37.5 billion in April. You might be wondering, why is Japan making this move? Well, it's not just about shifting some money around. This sell-off reflects a significant change in strategy by major Japanese financial institutions. They're reallocating investments to manage financial losses and adapt to changing economic conditions. One key factor driving this change is Japan's move away from negative interest rates. This shift has made local bonds more appealing to Japanese investors. As a result, U.S. Treasuries are losing some of their shine in comparison to these newly attractive domestic options. But there's more to the story. The depreciation of the yen has led to some interesting developments. The Japanese Ministry of Finance has been intervening in the currency markets, and part of this intervention involves selling U.S. Treasuries to support the yen. It's a complex dance of economics and finance, with each move having ripple effects across the global market. Now you might be thinking, so what? Japan is just adjusting its investment strategy. But here's why this matters. Japan's strategy to lessen its holdings in U.S. Treasuries could potentially impact the U.S. dollar's value. This isn't just about Japan and the U.S. It's part of a broader shift that could affect the dollar's global dominance. The potential consequences of Japan's actions are far-reaching. If Japan continues to divest from U.S. Treasuries, it could lead to unsettling fluctuations in U.S. financial markets. We're not just talking about bonds here. This could affect equities and currencies too. It's like pulling one thread and watching the whole tapestry of global finance start to unravel. Japan's divestment from U.S. Treasuries isn't just a response to immediate economic pressures. It's part of a larger trend that economists call de-dollarization. This is a fancy term for countries moving away from relying so heavily on the U.S. dollar in international trade and finance. So why should you care about all this? Well, these shifts in global finance can have real-world impacts on everyday people. Changes in currency values can affect everything from the price of imported goods to the cost of traveling abroad. If the U.S. dollar weakens significantly, it could lead to higher inflation and increased costs for American consumers. Japan's recent Treasury sell-off isn't just about numbers on a balance sheet. It's a move that could shake the foundations of global finance. As everyday costs fluctuate, a more profound shift is taking place in the foundations of the global economy. Japan's actions might just be the tip of the iceberg. What if the US dollar's reign as the world's reserve currency is coming to an end? The potential consequences of Japan's Treasury sell-off are far-reaching. One of the most significant impacts could be the weakening of the US dollar. As Japan reduces its holdings of US debt, it could lead to a decrease in demand for the dollar, potentially causing its value to decline. This isn't just about exchange rates. A weaker dollar could have ripple effects across the global economy. Higher treasury yields are another possible outcome of Japan's actions. As Japan sells off its holdings, it could lead to an increase in the supply of treasuries in the market. This increased supply, coupled with potentially reduced demand, could drive up yields. For the U.S. government, this means higher borrowing costs, which could strain the federal budget, and potentially lead to cuts in government spending or increases in taxes. But the implications go beyond just the U.S. economy. Japan's move could be part of a broader trend of diversification away from the U.S. dollar. This trend is influenced by a complex mix of factors, including geopolitical dynamics and rising U.S. interest rates. As countries seek to reduce their reliance on the dollar, it could lead to a shift in global capital flows. The Federal Reserve's response to inflation, characterized by rising U.S. interest rates, has increased the cost of holding dollar-denominated debt for foreign entities. This has encouraged them to seek more cost-effective financing alternatives. As a result, we might see a redirection of global capital flows, with higher yields on U.S. debt potentially attracting international capital. This could affect currency values and financial markets globally. The impact isn't limited to the U.S. and Japan. European markets could also feel the effects. If Japan decides to sell off its European Union Treasury holdings as well, it could lead to higher yields in European bond markets. This would raise borrowing costs for EU nations, potentially straining national budgets and affecting economic growth across the continent. Central banks around the world might need to modify their monetary policies in response to these shifts. As the landscape of global finance changes, monetary authorities will need to adapt their strategies to maintain economic stability and manage inflation in their respective countries. The interconnected nature of global finance means that Japan's actions could have far-reaching effects. A significant reduction in U.S. treasuries held by Japan could lead to heightened volatility in financial markets. This could prompt investors to adjust their portfolio strategies in response to altered yield environments, potentially causing shifts in various asset classes. For everyday people, these shifts in global finance can have real-world impacts. Changes in currency values can affect everything from the price of imported goods to the cost of traveling abroad. If the U.S. dollar weakens significantly, it could lead to higher inflation and increased costs for American consumers. On the flip side, it could make U.S. exports more competitive in international markets. The potential decrease in demand for U.S. treasuries could diminish the dollar's appeal as a global reserve currency, particularly if other nations begin to explore alternatives for their reserves. This could lead to a fundamental shift in the structure of the global financial system, with far-reaching implications for trade, investment, and economic policy worldwide. While economic forces are reshaping U.S.-Japan financial ties, political winds are also stirring. The next U.S. president could dramatically alter the course of trade relations between these economic giants. How might this impact not just two nations, but the entire global financial system? The upcoming U.S. presidential election is set to be a pivotal moment for U.S.-Japan trade relations. Different candidates are likely to bring contrasting approaches to international trade, which could have far-reaching consequences for both countries and the global economy. Let's look at two potential scenarios. If Kamala Harris were to win the presidency, we might see a continuation of the Biden administration's approach to trade. This would likely mean a focus on multilateralism and collaboration with Japan. Harris would probably work on reducing trade barriers and fostering economic cooperation between the two nations. On the other hand, if Donald Trump were to return to office, we could see a very different picture. During his previous term, Trump embraced protectionist measures, including tariffs on Japanese imports. These policies aimed to protect U.S. industries and reduce trade deficits. If Trump wins, we might see a return to these strategies, which could strain U.S.-Japan trade relations. The outcome of the election could also influence Japan's investment decisions regarding U.S. treasuries. If policies favorable to Japan are implemented, we might see renewed interest in U.S. government bonds. However, if tensions rise or economic conditions become less favorable, Japan might continue to reduce its treasury holdings. These potential shifts in U.S.-Japan relations could have significant ripple effects on the global economy. For instance, if Japan continues to sell off U.S. treasuries, it could lead to higher government borrowing costs for the U.S. This might reduce available funds for public services and investments, affecting the lives of everyday Americans. Moreover, the repercussions could extend to global capital flows. Rising yields on U.S. debt might attract international capital, affecting currency values and prompting central banks worldwide to adjust their monetary policies. This could lead to changes in exchange rates, impacting international trade and potentially reshaping the global economic landscape. It's not just about the U.S. and Japan, though. If Japan decides to sell off European Union Treasury holdings as well, It could drive up yields in European bond markets. This would raise borrowing costs for EU nations, potentially limiting government spending on essential public services across Europe. The future of U.S.-Japan financial relations will depend on several key factors. Economic conditions in both countries will play a crucial role, as will global market trends and geopolitical developments. The policies of the next U.S. administration will be particularly important, potentially setting the tone for years of economic interaction between these two powerhouses. As we look to the future, it's clear that the relationship between the U.S. and Japan will continue to be a critical factor in shaping the global financial landscape. Whether we see continued diversification away from U.S. treasuries or renewed investment under different economic conditions, the decisions made by these two countries will have far-reaching implications. In this video, we've explored Japan's reduction in U.S. Treasury investments and what it means for the global economy. This shift signals big changes in how countries manage their money and could affect things like currency values, trade relationships, and economic stability worldwide. Remember, Japan's actions aren't happening in isolation. They're part of a bigger picture where countries are rethinking how they invest their money. This could lead to changes in the power of the US dollar and how international trade works. As we've seen, even small changes in how countries invest can have big effects on the world economy. These trends might shape the future of global finance, so it's worth keeping an eye on them. Thanks for watching, and don't forget to subscribe for more videos on African and global affairs.